So it's Doug McIntyre here, the editor-in-chief at 24/7 Wall Street, and our most senior editor, writer on markets, stocks, finance, Lee Jackson is with me. Lee, we just had the Fed make its announcement about what it plans to do with rates. What did you hear?
Well, I heard pretty much what was expected. And Powell has been in a rough spot because he's been crucified for what he had to do as a result of something he didn't start, years ago. And I think what the word on coming from him is that the interest rate increases are likely over for good, unless there would just be a massive spike in inflation. And I think the message to the markets is these rates could retain at this level for longer than they expect. I mean, there was at one point some high odds that there would be a March decrease in rates. It's not going to happen.
We're seeing something now that I haven't seen in my adult life. You've got almost full unemployment, at least the way that economists would describe it. High consumer confidence, very impressive GDP growth. Among developed nations, we're number one in GDP growth despite our size. And you've got these unusually high rates. What's the story there? What am I missing?
Well, nothing. And you're right. I mean, we went through such a sustained period of lower rates, which literally started in 07 and 08 after the real estate collapse.
Yeah.
So when you look at it until when they started raising rates in 22, that was 15 years of abnormally low rates. And, when Powell tried to raise them in 2018, the market had a rate fit. And so they tapped on the brakes and lowered rates back down. And I don't think we'll ever see a 525 basis point move in rates in less than 2 years ever again.
One of the things that worries people, just normal Americans, normal consumers, is that interest rates are going to continue to make mortgages and things like car loans expensive. That really hasn't hurt the economy, though. To me, it's sort of shocking. You've got an economy that is able to absorb what I think is a huge blow when it comes to what it costs people to live.
Yeah, and the thing is though, even though the economic numbers do look good on the surface, and they do, there's a lot of the trailing underneath data that doesn't look as good. And I think you're going to see maybe some of this very strong momentum for the economy taper as this year goes on. We've written about for years the inversion between the 2-year bond and the 10-year note. And that inversion means that the 2-year is yielding more than the 10-year, where typically you're paid for longer maturities. And that, even though that inversion is tightened up, once it was well over 100 basis points, which is a full percentage point, it's got as near as 20 and 30 basis points. But history has always said, that an inversion like that in those two maturities means a recession is on the way. Now, whether it's later this year, even Jamie Dimon has said he thinks we could have a recession later this year. I think it'll be interesting to see, because I don't think this momentum can possibly stay in place.
One last question. Will the stock market throw a massive party if the rate cuts in the summer, or will there be an anticipation that's going to happen? So it's like, big deal.
Actually, when you look back at history, when they do start to decrease rates, often the market sells off, because it's all priced in, just like Microsoft and the big tech stocks that posted today. They put up very solid numbers, but the forward look wasn't really good. And they, buy the rumor, sell the news.
Well, Lee, since the Fed does this on a regular basis, and there'll be
all too regular,
all sorts of, guesses about next time, when we get the day after the next announcement, you and I are going to get together again, and we're going to talk about the same thing.
Well, and that'll be in March, and I don't expect that we'll see any sort of cut in rates, and probably the more of the same talk from Jay Powell.
Yeah. Take care of yourself.
Thank you, Stu.